Welcome to the 6th video in the course. This one is going to be on loans, decentralized loans, peer-to-peer. This one's exciting. Here's where you'll have some earning potential in the DeFi space. We're going to get into how it works, of course, and where you can access loans, and just really how you can start earning on crypto that you're currently holding, or crypto that you want to hold and start earning right now today. So how it works. So simply put, there are protocols out there on many different platforms and networks, both centralized and decentralized, that offer a lending and borrowing service for anyone. But almost all protocols on these networks require you to put up collateral, as in crypto, to borrow against. So there's no traditional banking way of lending out and borrowing, just because if you think about it, there's no trust on a decentralized, on the blockchain, because you don't know who you're lending to. There's no sort of trust between you. Whereas with banks and us nowadays, we have, traditionally we have credit scores and things like that to audit people and verify that they are a trustworthy individual. And so you can only borrow a percentage of what you put up as collateral. I would say anywhere from 15 to 75%. In my experience, that's typically where it ranges, and it depends on the platform you're using and whether it's centralized or not. So this obviously ensures that the loan will be paid back, or the borrower will lose their collateral if they don't pay it back. And so that's the purpose of collateral, as you know. That's the same with traditional financing. If you put up your car as collateral and you default on payments and you aren't making payments, they'll come after your collateral and take it to compensate. So in decentralized landscape, this is the only thing that makes sense, as I just explained. However, there are platforms out there that offer uncollateralized loans, just like a traditional bank, just like we were just talking about. But these loans are only available to large institutions, protocols, or decentralized apps. And it can't be any institution that comes to them. So it couldn't be any large institution, it couldn't be any protocol, and it could not be any dApp. They first have to be what is called whitelisted on this platform, which is essentially an audit of that protocol, dApp, or institution. And this is just their way of establishing trust between the borrower and the lender. So there are two sides to this, borrowing and lending. So for borrowing, you as an individual can borrow against your own cryptocurrency that you currently own for whatever purpose you decide. And that could be to purchase something, that could be to leverage against your crypto to take an even bigger position in crypto, no matter what it is. So, and then lending, that's the other side of it. You can lend out your cryptocurrency to others and earn interest on that crypto being lent out. Same as traditional banking, except now you are the lender and are earning on it rather than the bank lending out your money. So rather than there being an intermediary, just you putting your money in a savings account, quote unquote, and just keeping it there, collecting dust, you're now earning passive income on lending out that money for others to use. So you're doing exactly what the banks are doing, and earning, and making a living. Maybe not a living per se. It depends on the amount of liquidity or capital cryptocurrency you can lock up, but yeah. And so where can you access these services? If you are a large institution, dApp, or protocol, and need venture capital for any purpose, to expand your protocol, to develop some new dApp or protocol on your platform, whatever it may be, you can use Atlantis. Okay, and this is the platform I was referring to when I said you need to get whitelisted in order to receive any funding. So if you are a large institution, a dApp or protocol, and you want to get involved in some sort of decentralized funding, such as this is the place to go. This is Atlantis, and so they're actually not up and running right now. It's just, I don't want to say it's just an idea, but because they are bringing it to fruition, as they state, but it's uncollateralized crypto loans, a lot of L's. Atlantis is a capital-efficient DeFi lending protocol that enables crypto loans without collateral. And they say be first to know, so it's not available yet. But the thing is that us as individuals, we may not be able to borrow because we're not an institution or protocol or dApp, but we can lend. So we can provide, essentially what would be thought of as venture capital. So we'd be lending to these big institutions, these protocols and dApps. And the beauty of this Lendus platform is you have the ability to choose your borrower, right? And so I really like that part of it. When you put up your money and stake it, you get to be the deciding factor. So it's not first come first serve. It's not like someone can just come and say, yeah, I want to take Simon's money. You get to decide whether you get to decide between 2, 3, 4 protocols or dApps that come to you that want to receive your funding. So it just allows you to mitigate risk, or of them defaulting on payments. It also allows you to put your money towards something that you believe in. Maybe that's a gaming dApp or some sort of gaming development. If you're more passionate about gaming than something that has to do with insurance, then why not go for the gaming, as long as you've audited them and you see them to be a good fit, of course. So that's a cool platform, something I'm staying up to date on. I'll be, of course, letting people know in my Discord and everything about that. So then secondly, for individuals such as me and you that want to borrow against their capital, you can use many protocols, but here are a few that you can use to get started. So I'm going to give you a couple decentralized ones and then one decentralized. So Nexo, this is one I personally use. Very, very simple to do, very simple to use. When I first did it, so all I did was transfer from my wallet, my crypto wallet, which we set up, transferred it from there to here, my XRP, and I'm currently earning on it. I took out a loan from this to kind of leverage my capital from XRP into other cryptocurrencies that I'm interested in. So that's something you could personally do, not financial advice. But it was so simple. So I put it in here, and as soon as I topped up, as they call it, top up, just deposit is what it means. As soon as I deposited in here, I immediately was able to take out that money, like instant. There was no credit, of course there's no credit checks, any of that stuff. And this is a centralized platform, and so they insure all of your funds. So if you were to lose because of them, you would be compensated appropriately. So a very simple one to use if you're holding Bitcoin, Ethereum, XRP, any of these cryptos, Stellar, Dogecoin, any of these, and you are simply holding for the long term. It would probably be in your best interest, not financial advice, but me personally, I'll say that. Me personally, if I was holding any of these and I plan to hold for the long term, I would 100% put them in here and just start earning some passive income on it. As you can see, earn unavailable, as it appears that for these particular assets I can't earn, and that may be just because I don't have them in this account. But depending on your region, whether you're in the US, wherever you're at, just make sure you're eligible for this. I'm earning on XRP, so that's what leads me to believe that it's just because I don't have these cryptos in my wallet here. But nonetheless, this is a great platform, something super, super simple to use. As you can tell, it has a really good user interface, and I have had nothing but simple times with this platform. So secondly, let's get into another centralized exchange, Celsius. This one I'm going to pull up my mobile version. Let me show you here. So yeah, let me actually get into the borrowing portion of Nexo. My bad on that. So yeah, you borrow against it, and for XRP, I borrowed against this. So it says right here, my credit line is currently 796 or 800, and so it's about a 25% collateralized. So you can take out 25% of what your collateral is. So that's basically how it works. It's different for every coin. So Bitcoin, it might be like, if you have 100,000 Bitcoin, you can take out 50% of your collateral. So you could take out 50,000 as a loan. So that is basically how the borrowing works. As for you as an individual, it is collateralized, and it depends. It varies from token to token on the amount you can take out. So secondly, let's get into Celsius. So Celsius to get to borrow on this platform, you have to use the mobile app as it says here. So I'm going to pull that up. So this is the Celsius app. The only way you can borrow on Celsius is by using the mobile app. Okay. And if you go into the borrow tab on the website, it'll mention that. So here we are in the app. It's pretty much the same. I prefer the web when I'm doing the lending portion, which I've never personally done it, but it's just when I'm doing anything crypto, I prefer to do it on the laptop. But anyway, if you go into the borrow section, you can simply type in how much you want to borrow. It'll tell you how much you need in collateral for that specific asset. In this case, I want to borrow 1,000, and also you choose your loan to value percentage. So it could be 25, 33, or 50%. If you were to go to the 50%, you would simply just need 0.04 Bitcoin, basically 0.05 Bitcoin, in order to borrow that much money, in order to borrow 1,000. And then you can also choose the length of your loan, which can be paid off at any time. It's just a way to reduce the amount of interest, and just tailor it to your strategy. So if you plan to use this money to leverage into another token for six months, take out a 6-month loan. Me personally, that's what I would do. I'm not saying that's what you should do, not financial advice, of course. But yeah, that's it on Celsius. That's basically how it works for the borrowing portion. And here we have Anchor Protocol. This is a DApp, and basically it's pretty basic, especially if you understood the Nexo and Celsius portion. Pretty simple. You just go to the borrow tab of it. On this protocol, this DApp, you have the ability to both earn by lending or borrowing. And in this case, we're going to go through the borrowing and then lending later. But as far as the borrowing goes, it's pretty simple. You put up collateral, and in return, you can borrow X amount, depending on their collateral ratio, which, I've never personally used the borrowing side of this decentralized platform. When it comes to borrowing, I prefer to use centralized just because, it's safer, my money's insured, and, I just prefer it personally. You can do whatever you choose to do. And something that is actually cool that I noticed on here, this is actually a platform I plan to use as far as the lending goes, which we'll get into later. But with this, you can actually use the insurance that we talked about earlier. You can purchase insurance, which is cool. You can purchase through Nexus Mutual, Bridge Mutual, Insurace. So it's cool to see that. And I'm glad we covered insurance before this, because now you understand that insurance would protect you on this platform if you were to use it, if you were to purchase insurance prior to it. So, okay, and now you can use all 4 platforms mentioned on this slide to lend your money and earn. So at Lendus, as I mentioned, you can lend out and use the platform as essentially venture capital to invest in, up and coming protocols and new developments. So, and then you have Nexo, Celsius, and Anchor, so the same ones we've just covered. And so on this one, super simple. Basically, actually, you can use a calculator. So let's go into that. So interest, earn interest. Select your crypto assets. So let's just say you want to stake Bitcoin and earn. Okay, and you stake maybe 1 Bitcoin. Bitcoin right now is at 41,000. So we'll go with 41,000. Oh, I just gotta put in 1 Bitcoin, not 41. That'd be that's crazy. Okay, so 1 Bitcoin. Yearly, you'd be earning a little over $3,000, but that's only with that 12% interest on your assets. So the way you can get a higher interest is by holding more Nexo tokens. So there's a certain portion or proportion that you have to be, I'll just use an example of, you have to have, let's say you have $50,000 in capital that you want to stake. 10% of the value of your assets has to be in Nexo token to earn that top interest of 12%. Otherwise, it's going to be, I believe, like 6%. Because right now I'm earning only 6% on XRP. And so once you start to, or if you start to, like as you can see here, I'm at the loyalty base. My level is base. I'm silver, or I'm not silver. Upgrade to silver level. And so base only gives you that 6%. Whereas if you were top tier, you'd be earning 12%, which is your top rate. So you'd have to spend a little to make a little. Let's move over to Celsius. So on this one, you can stake all these different assets, and this is your guaranteed rate. So you have, if you're holding, let's go right into Bitcoin, so 5% there, 5.35 for Ethereum, USDC coin, which is 7.10%. I much rather, like personally, I prefer staking stable coins because they're pegged to $1, and you're guaranteed, you know, if you're holding $10,000 worth of USDC coin, you know, you're gonna be guaranteed 7% of that, and it's not going to fluctuate. Whereas if you're holding a volatile asset like Bitcoin, you know, the value of Bitcoin could be 50,000 one day and then 25 the next, you know, because it is very volatile. You know, it's maturing, of course, as we've seen, but it's maturing as an asset. But you know, with that volatility, you're not guaranteed X amount of dollars every month, year, etc. So I much prefer that, but they have a very wide variety. TUSD, Tether. So something, if you are interested, check out Celsius. And same with this one, they have certain promos that they do where you can earn even more. So you can earn up to 14% APY, and they also do the same way Nexo does that token thing, where you can, if you hold 10% of the value of your capital or your liquidity, you will earn more. So they do that same, they follow that same principle. So something to keep in mind. And now, lastly, this is where I personally like to keep my money. Not on this platform per se right now. I'm staying out of all lending protocols just because of we're in like what I perceive as a bull market. So I am keeping all my money liquid and ready to, you know, exchange in and out of cryptocurrencies as the market moves. So here we go. Let's do earn. So the current APY is 19.32%, which is pretty dang good, considering, you know, a return on your money. Because if you were to put $100,000 into this and just hold it there, you'd be earning, you know, $20,000 a year just off of this protocol here, which is very simple. And how the interest rate can be that. Some of you might be wondering, like, how can it be 19%? And I was looking into that myself just because I wanted to, you know, give you guys an explanation for that. And basically, governance sets that anchor rate. The anchor rate is the interest rate, that 19.32, and the staking rewards make up the real yield. So there's the anchor rate, and then there's the real yield. So anchor rate is just kind of the prediction of what the APY is, but the real yield is actually what you're making, what the real APY is. So underneath the hood, Anchor implements the classical money market with the caveat that whitelisted collateral is reserved for liquid staking derivatives of major proof-of-stake protocols. The collateral earns staking rewards, making up the real yield. So what they're saying here is that Anchor, this dApp, this protocol here, what they are doing, so if you go to the dashboard, you see that the total value locked in this platform is $19 billion, $19 billion, close to 20 billion is how much money they have locked up. That's how much people are staking. That's a lot, you know, and that's one way of determining that a protocol is valid, that a platform like this is valid, is seeing how much value they have locked up. So if they only had 1 million locked up, I'd be a little leery as to, you know, putting my money into it because of that. And, you know, maybe I'd put some money I don't care about in it, some money I'm okay with losing, but not a portion that I would, you know, I can't afford to live without. So that's one way of determining if a dApp is valid or not. And then, so yeah, you see that 19 billion, back to what I was saying before. They use that 19 billion and they stake it in other proof of stake, which we'll get more into proof of stake later. But essentially, they're staking this. They're locking up that 19 billion to earn, let's say, 25% somewhere else. And so they're making that 6% difference, and whatever they make, whatever they are earning in excess, is put into their reserves. Okay. And so that's how that yield is made up. They're simply taking your assets, locking them up somewhere else to earn an even higher yield and earn even more money on it, and then paying you out. So that's how that yield is made up, for those of you that are wondering. And that's reserve that I mentioned too. That is for the purpose of if they lock up their assets somewhere that is not earning more than 25%, that is not earning more than, I should say, 19.32%. Those reserves are they are there to compensate for that mishap. So let's say they're earning 18% instead of 25% 1 week. They will dig into their reserves to pay out all of their lenders. So that's how it works. With these decentralized ones, there's of course risks involved, which we're going to get into right now. All right, so here are the risks associated with everything I mentioned in this video. Some of these risks they do apply to things we'll cover later in the course. But so firstly, you have impermanent loss. And so this only applies if you're switching from one asset to another in order to lend it out. So let's say you switch your Bitcoin, which at the time is worth $40,000, into USDC. And so now you have $40,000 worth of USDC and you lend it out. You lend out your USDC for, let's say, 1 month. And in that month, you earn $2,000. But at the end of that month, Bitcoin is now worth 45K. So if you had just left your Bitcoin alone, instead of switching it into USDC and then staking it, you would have made $5,000 instead of just $2,000. So your impermanent loss in this case would then be $3,000, because you could have left it and it would be 45,000, but you didn't leave it. You switched into USDC, staked it, and made 2,000. So now you have $42,000, whereas you would have made 45 if you would have just stuck it or left it where it was. Okay. But it's only impermanent, and the reason it's called impermanent is because you have not swapped your USDC back into Bitcoin. So you could wait for Bitcoin to drop back down to 40,000, but there's no guarantee that will happen. So impermanent loss is something we will talk a lot about as it gets more complicated, as we get into liquidity pools where you lend out 2 assets at a time. But there will be a lot more on that later. But instead of going through all of that hassle, you could have just simply staked your Bitcoin on a platform that accepts Bitcoin staking, like Nexo, like Celsius, and just earn 5-6% and not have to deal with all this impermanent loss as one of your risks. So that's just a way you could mitigate and just not worry about it. Set it and forget it type of thing. So secondly is rug pulls. So in the past, there have been protocols in the past that were set up only to induce people to lock up their liquidity with the protocol using high percentages, high APY as the incentive to do so. So they'd lure people in by saying, you can earn 100% on your money by putting it here. And then they would just simply pull a rug on them. And so the protocol in its genesis would create what is called a backdoor, what is referred to a backdoor in the code, that can be executed at any time to run with the money that is in the protocol. So, educate yourself on the platform or protocol you plan to use to best mitigate risk. Educate yourself on, go through that Anchor, like I did with Anchor, go through the docs that they have, go through the white paper, look at their team they have behind it, the people who developed it, make sure there is some sort of, start to develop some trust between you and that platform. So you're not just, hanging there hoping that they don't pull the rug on you, because there have been some massive ones in the past. But anyway, thirdly, we have hacks. So there have been major hacks in the past of protocols whose code was insufficient. So one hack resulted in the loss of $600 million in total value locked. That means there was $600 million on the platform, and some hacker got in and ran with it. And so this is something that is hard and almost impossible to protect yourself against, because not everyone has days and weeks of time to pour into the coding of a platform to verify its validity, let alone the skill to pour through that code and verify that it's good. And so the best you could do to hedge against this risk would be to take out a DeFi insurance policy. What we covered a few videos back. Taking out an insurance policy. But this is my next point. But not every protocol and platform is covered by the insurance policies, like we noticed. Only certain ones are covered, and so if you're entering a protocol or dApp that is not covered by these insurance platforms, you just got to go with the risk and hope for the best. And then lastly, we have bugs. So this can also be hedged against using insurance, and is something that is almost impossible to get rid of at this point. They can be fixed before the launch of a protocol by auditing the code, but this is entirely in the hands of the developer. So, there are platforms out there right now, like I'll use Flare Network, for example, flarefinance actually. They're using a code auditing service to verify that everything is good, everything is running smoothly before they take it live, before they launch their mainnet, and start to lock up a lot of liquidity, and that's something that points you to the conclusion that a platform dApp protocol is, they have your best interest at heart, because they're going through so much time and effort to ensure that there are no bugs, that there are no potentialities for hacks, and that everything should be running smoothly. So that's just something I look for, something that you can look for yourself to verify that a platform is valid and they want the best, and they want to truly invent something and bring something great to decentralization, to the blockchain. So that's it. That's it for this video. In the next one, we will be covering liquidity pools, and no, actually it'll be yield farming, which I'm very excited about. That's something I first got into with DeFi, so it's exciting, and there's a lot to unpack there. So I'll see you over there. If you have questions, comments, concerns on this video, reach out to me in the Discord or at my personal info. And one thing I do want to mention is that I have referrals to Celsius and Nexo in the description, so we'll both earn if you click on those links. I think it's about $25 worth of Bitcoin they send to each of us if you, upon your $100, I think it's about $100 that you deposit. So let's use those referral codes if you please. But yeah, I'll see you in the next one.